Hi, let's work through the requirement of closing disclosures as a settlement statement. Uniform Settlement Statement. The Consumer Financial Protection Bureau provides a closing disclosure explainer tutorial. This tutorial is crafted for consumers to understand this important financial document. It can be found at http://www.consumerfinance.gov/owning-a-home/closing-disclosure/. If a buyer is securing a loan for the purchase of real estate, the buyer will receive an estimate of expected closing costs on a loan disclosure. The Real Estate Settlement Procedures Act requires that the loan estimate be given within 3 business days of the buyer having applied for the loan. The loan estimate discloses key features such as cost and the risk of the mortgage loan. Then, at least 3 business days before the loan and real estate deal closes, a closing disclosure must be presented to the buyer. The closing disclosure details all the costs associated with the closing, including lender fees, real estate agent commissions, title closing fees, APR, and monies prorated between the buyer and the seller. See Section 13 for more information on the Real Estate Settlement Procedures Act, loan estimates, and closing disclosures. This closing disclosure is a 5-page document presented in a similar format to the loan estimate. The purpose of using the same format between the loan documents is that borrowers can ensure that they are closing with the loan terms quoted at the outset of the process. At this point, you may want to stop because the following slides are presenting information from a sample closing disclosure that you will find just after this PowerPoint slide section. So you may want to stop, advance to that unit within the course, and print that out if you think that would be helpful for you to make it easier to follow along with the slides. But if you stop and do that, do come back to this slide and continue on to slide number 36. The information is presented on the slide, so you don't have to do that, but just giving you a heads up just in case you think it'd be easier to have that in front of you. It's completely your choice. Samples closing disclosure provided by the Consumer Financial Protection Bureau. Michael Jones and Mary Stone, currently residing at 123 Anywhere Street in Anytown, State 12345, is purchasing a property from Steve Cole and Amy Doe of 321 Somewhere Drive. The purchase price is $180,000. Michael and Mary put $10,000 down as earnest money and took out a loan for $162,000 at 3.875% interest rate. Their estimated PITI or pity monthly payment plus mortgage insurance is $1,050.26. Steve and Amy, the sellers, agreed to pay $2,500 toward the buyer's closing cost. Plus, they paid for home inspection and a home warranty. At closing, Steve and Amy had their own closing costs to pay, which included $11,400 in real estate fees. They also had to pay off their mortgage of $100,000. They had a credit coming for advanced homeowner association payment, but still owed their part of the year's real estate taxes. This graphic is actually the top of the closing disclosure, which fits the scenario that was just read. As you can see, it's showing the borrower's name and address along with the seller's name and address. You have information at the top, including the date of the closing and the lender, where the money is coming from. You can see the loan amount and the rate of interest that is being charged, along with the actual purchase price. You also have other loan information on the far right, such as how long the loan is being taken out for, and in this case it's a 30-year loan and it's a conventional mortgage. Page 1 of the closing disclosure provides details about the loan terms. It also provides details about the required monthly payment. Plus, it summarizes the amount of closing costs charged to the buyer and the amount of cash the buyer needs to bring to closing, usually wired directly immediately before the closing. It is presented in the same format as on the required loan estimate for the buyer to make a fair comparison between the two documents to ensure that the terms promised from the lender matches the actual closing disclosure. So continuing down on page 1, you can see that Michael and Mary are getting a loan for $162,000 at the rate of interest of 3.875%, with a principal and interest payment of $761.78. There is a prepayment penalty, which we know because the lender has to indicate whether one exists on page 1 of the form. And in this case, they've marked yes for the prepayment penalty and no for the balloon payment. Page 1 continues by breaking down the buyer payment. And the reason it's reflecting a slightly lower payment for years 8 through 30 is the lender is estimating that the mortgage insurance will be dropped once the buyer has paid a certain amount of payments to drop off the need of the mortgage insurance. And so that in the years 8 going forward should save them over $80 a month in the payment. So we do have the $761.78 as the portion that's going towards principal and interest, but we also have a mortgage insurance payment of $82.35, plus the lender is collecting escrow to cover property insurance and taxes of $206.13 every month, creating an estimated payment of $1,050.26. Finally, page 1 summarizes the amount of closing costs charged to the buyer and the amount that the buyer needs to bring to closing as cash. Now, these numbers are explained in detail on page 2 and 3. Page 1 simply has the totals of those costs and the cash required to come to closing. So in this case, we have $9,712.10 as the total closing cost, with the buyer needing to bring $14,147.26 to closing. Page 2 presents a breakdown of entries affecting the buyer, including loan cost. Any loan servicing fees are included for which the buyer was charged but had, quote, no control over, end quote, such as a credit report fee. Other items are added that the buyer chose the provider for, such as a survey company. The buyer's loan fees are totaled halfway down page 2, followed by the inclusion of the other buyer's costs, such as escrow fees for insurance. Page 2 ends with the buyer's total closing cost. This amount must match the figure entered on page 1. Also on page 2, right of the buyer column, are any expenses charged to the seller. These generally include real estate brokerage commission, seller paid inspection, or home warranty. So here is part of page 2 where we are seeing the loan cost. The loan cost includes things like application fees, the underwriting fee, and the points paid. Page 2 shows the services that the borrower was not able to shop for. And the reason that you're seeing the fees that the buyer paid split between two columns there, as you can see, the $29.80 for the credit report fee is over to the right, whereas the other fees are being shown on the left. The $29.80 was a fee that the lender actually charged the borrower before they ever pulled the credit report. So it's not a fee that's actually due at the time of closing, but it's still a fee that is required to be disclosed on the closing documents. Those would be things like the cost of the appraisal. The buyer does not get to choose the actual appraiser, but they will be charged the fee for the appraisal. And then also on page 2, here we're seeing the services that the borrower was able to shop for. So the borrower would like to have the property inspected in order to purchase the home. They're going to choose their own inspection company. They're going to choose their own survey company. They're going to choose who they're using for title insurance for a binder policy. And then the loan cost, including the items that the borrower shopped for and was charged but not allowed to shop for, is going to be totaled. And then you'll find the summary of the other costs, taxes, and prepaids. Those are items such as the amount of homeowners insurance that has to be collected. Plus, page 2 is going to break down any escrow being collected. That would include property taxes being held, the mortgage insurance, the homeowner's insurance, things like that. And then the category of other costs would be things like the fees for HOA processing, maybe an application for the HOA, the home warranty fee, and then also the accounting of the real estate commissions and things like that. Those are all under the category of other costs. Until finally on page 2, we have our actual total of other costs and closing costs all brought down together with the summary. And again, those figures will match then back what is on page 1. Page 3 presents items prorated between the buyer and seller, such as property taxes. Plus, page 3 reflects other items only attributed to either the buyer or the seller, such as a credit to the buyer for either an earnest money deposit or a mortgage from a lender. Any amount required to pay off the seller's existing mortgage would be entered as a debit to the seller on page 3 as well. The purchase price is shown in page 3 as a debit to the buyer and a credit to the seller. If there are unpaid closing costs on page 2, these will be added on page 3. Final totals are presented at the bottom of page 3. These totals reflect how much is due from the buyer at closing and how much the seller would leave with at closing, short sales excluded. The buyer total would match the amount presented on page 1. Page 4 and page 5 of the closing disclosure are informational pages and disclaimers. On page 3, you will see the breakdown of the estimated cash to closing that was given for the loan estimate with the comparison for the actual final numbers. So here's the beginning of page 3, showing the summaries of the transactions due. And there on line K, you can see the amount due from the borrower at closing, with M being the amount due to the seller at closing. That's after everything is said and done. Now, the amount due from the borrower at closing in this case is $189,762.30. That is not equal to the amount that you saw on page 1, which showed how much the borrower was to bring to closing, because in this case, the borrower is actually getting a loan to help cover some of that cost. On line 1 there, remember we're doing a double entry system, so the sale price gets entered on the buyer side as well as the seller side, and this is where you can definitely see that starting to happen. And then you're going to have the proration adjustments for county taxes, because remember the seller is paying those behind, so there's going to be an adjustment to credit the buyer for what the seller owes, and vice versa for the HOA fees, because the seller paid HOA fees in advance. You can see on this part of page 3 where it shows that the deposit being given as a credit to the buyer. Now, the deposit is not actually part of the double entry system, because that deposit is not in the seller's pocket, so to speak. It's actually being held in escrow by either the title company or the broker that collected it. They would make sure that the title company had it in their possession at closing. You also have the loan amount there of $162,000 being entered on the buyer side. the taxes, etc. And working our way down on page 3, then you'll find where it's actually totaling and showing you how much cash is going from or to the borrower, and generally it's from the borrower, and then cash to the seller. In this case, the seller is collecting $64,414.96, which is less than the purchase price because the seller actually had their own mortgage that had to be paid off on the property. Now, the reason that there's a check mark as cash to or from the seller is if it was a short sale, it could be that the seller has decided in order to walk away from this property and to be free of it, that maybe they're going to bring $5,000 or $10,000 to closing because they actually owe more on the property than what the house is worth. They owe more on the loan than what the property is worth. So it is possible during bad times to actually see where that X says from the seller instead of to the seller. Definitely not your ideal situation. Closing disclosure. The closing disclosure likely seems like a very tedious exercise at this point in your studies, but I really encourage you to slow yourself down. It is not only important for testing, but it is the very document that will become part of every real estate closing. After all, it is all about the money. The closing disclosure will tell your buyer how much to bring to closing, and it will tell your seller how much is being gained at closing. It will even tell you how much commission is being paid to your broker and you for the sale. It is crucial that you learn to read and ensure that items are being entered correctly. I have worked with many good professionals, good closing agents, who help to prepare these documents. Even so, countless times I have picked up the phone and said, hey, it looks like you didn't credit my buyer the closing costs as agreed upon in the contract, for example. This is your job as the agent. Make sure that the numbers add up correctly. Make sure that they reflect how the contract was written, and cash your commission check when it's all done.